Joining me right now is the Satori Fund founder and portfolio manager, Dan Niles. Dan, it is great to see you this morning. Thank you for being here. Right off the bat, got to give you a huge shout out. We talked at the beginning of the year in January, and you went through some of the important themes that you were expecting, and you gave us a list of your favorite stocks, what you were investing in. That group of stocks is already up 22% on average year to date in 2021 after a fantastic performance the year before. Congrats, Dan, on this performance.
Thank you very much, Maria. Appreciate it.
So let's talk about what you're expecting for 2021. When we spoke in January, you talked about inflation being a theme, picking up, and technology struggling. That's exactly how it's playing out. What do you see in terms of the big 30,000 feet themes for 2021, Dan?
So I think from here, we don't actually have any software shorts anymore. And that was one of the sectors we were massively short this year, thinking that rising interest rates, 10-year Treasury yields, of course, are now about 1.6%. They're above the S&P dividend yield for the first time since before the coronavirus. And we thought that would just compress tech multiples that had gotten way ahead of themselves. But in the near term, you've got the 1.9 trillion COVID relief plan that'll probably pass in the next 48 hours. On top of that, you have another 3 trillion in stimulus for infrastructure coming this summer. And the Fed keeps buying about 120 billion in bonds a month. So you add those three things together, that's another 30% of GDP in stimulus coming into the market. And money supply is already up 26% year over year before that stuff hits. So it wouldn't surprise us in the short term to see the market potentially get to a new high, just driven by all that stimulus like it's been done for the last 13 years ever since the global financial crisis. But we think inflation going up is going to become a big problem, and we think by sort of mid-year, that's it. And, as rates get above 2% on the 10-year, the Fed starts to talk about maybe having to taper. We think the market's going to have a very big problem in the back half of the year driven by that. So that's kind of our roadmap right now as we see it.
It's interesting to see that the market has a big problem toward end of the year, even as an economy is improving. Now, one of the themes you continue to look at is an economy that is improving. That's why you've got this inflation theme. And that's why one of the picks for you was the oil sector, the XLE. Tell us about the oil sector and what you would be doing now in terms of this group, given that the major oil stocks have rallied quite a bit in 2021 already. Oil back above $66 a barrel.
Yeah, I think if you look at the whole commodities complex, whether you're talking agricultural, oil, metals, they're all really in the same theme. And that theme is that for the last, arguably decade, there's been underinvestment in all of those sectors because GDP growth from 2010 to 2019 in the U.S. was about 2.3%. It was the weakest ever recovery from a recession that we've ever had. And so a lot of those companies had a lot of debt. They underinvested for quite a long period of time. However, if you look at this year coming up that we're in, we're probably going to see the fastest GDP growth at 7% since 1984. And combine that with underinvestment plus a focus on green energy, and I think you're going to see commodity prices across the board really start to go up. The reason we picked energy was a really simple one. That was the worst space by far last year. It was down 37%. With the S&P up 16%. And our view was when people start to get vaccinated, we start flying again, we start driving again, oil demand as well as demand for all commodities is going to start to pick up. And we wanted to be in the spaces that we thought would really benefit. And that's why you've seen, the XLE up 40% year to date. But remember, it was down 37% last year, so it's not even back to even. So we think there's a lot more room to go in that whole commodity sector.
What a great call. We're looking at your 2021 stock picks right now, Oracle, and then you've got sports betting and gaming ETF. You've got Magna International, JP Morgan, and the Spider Energy Index as well, the XLE. Let's talk about the economy recovering and what areas or specific stocks benefit most. The House is likely going to pass this $1.9 trillion stimulus deal as soon as today. That's more than $5 trillion in new money thrown at this economy in a year, Dan. And you've got J.P. Morgan as a beneficiary. Walk us through the theme around JPM as interest rates also spike, which is another positive for the banks.
Yeah, I think with banks, if you step back, you have to look at the big picture. They're obviously driven by loan growth, and loan growth is driven by economic growth. So if you believe GDP is going to be 7% growth this year, that's obviously great for the banks. As the yield curve steepens, so the 10-year Treasury goes up and the short end of the curve, doesn't move up as much, that's also great for banks, and that they can lend out money and make a much better return on that. So that's a positive as well. Obviously, you need loan growth, and with the Fed handing out, incredible amounts of free money, the government handing out incredible amounts of free money, maybe people don't need to go to the banks as much. So you need to keep that in mind, obviously, as you're thinking about them. But GDP growth of 7% plus this year, that's going to be fantastic for the bank stocks. And they've been under pressure for the last decade, and arguably you could say for the last 40 years, as interest rates have just continued to come down. And so if you are actually at a structural turning point where inflation picks up and it's going to not be just temporary, which is what the Fed believes, I don't believe that. I think this is going to be more persistent. Then that should be a much better environment for the banks going forward, especially given how unloved they were. Don't forget, J.P. Morgan might be up 20% this year, but it was down 9% last year. The entire financial sector was down last year. It was, I think, the third worst performing sector in the S&P 500. Energy was obviously the worst at down 37. But we feel like there's a lot of catch up still left in those names as the economy improves. But that's bad again for tech as rates go up, because last year technology was the biggest beneficiary of 10-year Treasury yields getting to 0.5%, and from COVID accelerating a lot of trends like e-commerce or streaming. That's going to obviously hurt them as we're all out at restaurants and on vacation and driving places versus being glued to our screens because we have nowhere else to go.
Well, I get all that, but big tech was really showing some fantastic performance, as you say, during the pandemic. Why have things changed just because of the 10-year yields rising? I mean, the 10-year rising to the highest point since the beginning of the pandemic really unnerved markets 2 weeks ago when we hit 1.6% on the 10-year, and we're back at that right now. I love what you said earlier that you're no longer shorting software. Oracle is the only tech stock pick that you have in 2021. What's the story behind big tech, and why did big tech roll over so much when interest rates moved higher?
Well, there are two pieces to it. One is obviously COVID made it so we're all stuck at home. So we're streaming more, we're ordering more online, we're entertaining ourselves online, et cetera. So you saw, trends in those spaces accelerate by 2 to 3 years. Obviously, as we're all out, going back to school, going back to work, going on vacation, et cetera, we're not going to be buying as much stuff online. We're going to be doing some of those other activities. But with regards to your interest rate question, if you're in a technology stock and your view is 10 years from now, electric vehicles are going to be big. Don't forget, electric vehicles are only 3% of the market today. But if your view is 10, 20 years from now, it's going to be a huge sector of the market. Well, if you're discounting back the cash flow from 20 years to now and your discount is at 0%, then the value of that money 20 years out is the same as it is today. If rates go up, it's worth a lot less today than it is 20 years from now. And that's kind of in a nutshell the problem with multiples for big tech as rates go up.
It makes a lot of sense. Before you go, Dan, we've talked a lot about these specific situations, the names that you're invested in, but you also said the broader market is going to have a problem second half of the year because of all of this stimulus, because the Federal Reserve's will begin talking about tapering. How significant a sell-off might you expect? And where will the most selling be when you look at the averages? What kind of quantify it for us?
Yeah, I think in the back half of the year, if you hear the Fed saying we think inflation's more persistent than we thought, and we're going to have to dial back some of the stimulus, I believe the S&P is down 10 to 20% in a matter of a week or two. That's the short answer.
All right. Wow, we will leave it there. Dan, great analysis as always. Love talking with you and having you on. Thanks very much, Dan. We'll see you soon.
My pleasure.